Hey there, this is David Cox, Senior Portfolio Manager at Financially in Sync at Raymond James in Waterloo, Ontario, Canada. Today on the webinar, Where Do Investors Stand? It is Friday, April the 11th, 2025. Let's get started now. Lots of change happening here. We've had what is basically looks like a crash or a mini crash that has taken place here. Really started before last week's webinar. But you can see here in the last week here, we've been just absolutely punished here from anything to do with risk assets for the most part. Gold being the one sole thing here up at the top of the list that is up on the week anyway. The short, intermediate, long-term trend. We've had a lot of trend changes here. So again, let's just get into it, but a reminder to pause your video player at any time for more detail. S&P 500 on the left here, you can see we pulled back all the way almost, pretty much touching the peak that came in late 2021, early 2022. So again, this has been a very, very quick kind of sell-off, to say the least. And again, certainly I understand raises concerns. If we look on the right side, I've blown up the same behavior. You can see what started out as again, a relentless kind of, crushing correction that then stabilized and attempted to find some kind of base before, again, firing off some kind of buy signals and whatnot. Turned into, essentially a crash. We had a minus 5% day that was on the Thursday last week there on April 3rd, another 5% day on the 4th, and then again on the Monday, we opened down considerably, although rallied back. The market has been extremely volatile, extremely volatile. I'm circling this red circle here down at the bottom. Again, this is right in the face of, VIX surging, and then again, markets just kind of sitting at alternate lows here at this point after a huge rally that took place earlier this week. I had to kind of capitulate, which is always it's always disappointing. It's always challenging. We sit here and all of us are subject to this. We get we sit here, we face headlines, we start to build up and mount risks in our minds, and again we start to lose track of the the impact that can have on finances, and certainly the mental energy and mental capital that goes into being a participant, right, in terms of this world that does seem crazy at times, and indeed is. Just again, very, very important to always kind of keep that perspective, right? So from the NASDAQ composite perspective, the NASDAQ has been certainly a much more technology heavy market. You can see it's now actually off 26.5% to the lows. You can see that blue line is the 200-day moving average. So on the left side of your screen, you can see where the peak happened. We spent 259 days below the 200-day moving average, broke out on early 2023, spent 526, almost twice as much time above the 200-day moving average, and now we've fallen below. It's not a focus index by any means. At the same time, I think it's still context and it helps us understand the environment. Let's take a look at the InSync Universe stock. So again, a reminder, the InSync Universe is a screen that we created, and it includes stocks that have outperformed the S&P 500 on a 1, 2, 3, 4, 5, and 10-year time frame. There are currently, as of the last quarter, at the end of March, there are 144 stocks that meet the screen. In the top panel, what you see is essentially a equal weighted composite of all those 144 stocks. In the bottom panel, you can see they have steadily, as a basket, outperformed the S&P 500. That's by definition. But a reminder, when a market is falling, outperforming the market is not as good, or certainly as fruitful to the bottom line as going up in the absolute sense. And you can see on the top panel, here's the weekly candlestick charts, and you can see here again, this is a lower low, right? And so this is the problem. We have a lot of stocks here that, no doubt about it, are going lower. In fact, it's probably easier to say there are few stocks that are rising, and that again refers to market breadth and whatnot. But again, we always need to keep this in context. I want to talk about gold and silver, of course. Here's gold, 102 ounces almost essentially of silver it takes to buy 1 ounce of gold. From this perspective, one could argue that over the course of the last several decades, this makes silver relatively cheap. I'm going to flip the chart on its head, and the reason I'm going to do that is to make clear also that from a trend perspective, silver is underperforming gold. In fact, you can see here quite clearly in the last 4.5 years, it has been making lower highs, it has made lower lows now, and has been underperforming. So like all things, relatively, we want to own things that are stronger than any kind of alternative that we have the opportunity to invest in, because it's important. We're taking risk as investors. It doesn't matter whether we're investing in gold, whether we're investing in stocks, whether we're investing in bonds for that matter. We are taking risks, and we need to understand those risks. This is gold stocks divided by gold bullion, and this is put here as a reminder that gold stocks on the whole have not done very well. They have not done very well versus gold itself, and gold is far less volatile, and that is a good thing. So again, gold stocks, sure, could they eventually come up and start to surge as an entire group? Of course they could. That being said, here they are, and they are very strong in recent months. This is the Toronto Gold Stock Index, the XGD. You can see here I've just marked the recent breakout that took place in March. Here's a pullback, and so again, any strong sector, and this is actually without question the strongest industry group I look at. This was a recent pullback last week here, and again, oversold, RSI 5 oversold. These are moments when I like to add to gold stocks in this case, if that's what we're interested in doing, which is investing in relatively strong and absolutely uptrending securities, which is essentially what this is. Now, here's a couple of gold stocks that we've looked at before in this webinar, but again, Agnico Eagle on the left, dual listed, AEM in Toronto and the US, and Lundin Gold, a little less liquid, but either way, you can see I've plotted these versus gold itself, so you can see that even though gold stocks I just showed are underperforming gold bullion, there are certainly many stocks within that are actually performing much better. Again, here's some of these examples of stocks that we all know. These are actually dual listed stocks. Any Canadian knows these companies. Rogers, Bell Canada. I mean, these are companies that you probably have your internet with, your phone company. Canadian National Railway and Cenovus, which is the old Encana. The reality is that these are pretty ugly downtrends. So do not let anyone tell you that these are falling because of Trump. They are not. They've been falling for the last couple of years. Again, that's why it's always important. Again, just look at price, right? The narrative and the media does definitely mislead us. And again, here we go again. Canadian dollar is in an uptrend. As I pointed out earlier this year, the Canadian dollar bottomed. I'm joking here, but because of the threat of tariffs, again, something that would obviously be negative for the Canadian economy and the Canadian dollar. That's what the media told us. They were wrong. The Canadian dollar is now bouncing. I've drawn a line here on 72 cents. This has been the bottom here that took place in 24 and 23 and all the way back to 22. It's kind of an important inflection point on a shorter term basis. Okay, so from that perspective, I certainly don't think it's time to just kind of go and kind of run for the hills if, for example, you're trying to go and convert all your money. At the same time, our clients and certainly via our have cut exposure considerably to the US dollar, and the reason is because as a Canadian, from a Canadian vantage point, this is of course a risk. The Canadian dollar rises, which means the US dollar is falling. And again, from a US centric standpoint, this makes actually looking at foreign equities, of course, more interesting, and certainly Canadian equities. But again, as I remind you, as I already reminded all of us, we always want to be aware of the trend. We want to be aware of the relative trends, yes, but the absolute trend is very important. Finish off with Sector Watch. You can see there's the gold stocks up at the top of your list and everything in between. The energy stocks absolutely punished this week. There's the REITs, there's the financials in Canada. A lot of ugly behavior here. Interest rates have also kind of popped back up here, or yields rather. Again, but the bigger picture I think is important here. We've got a lot of red developing here, and again, the markets have got lower lows on them pretty much everywhere around the board. So we want to be very, very careful in terms of what we expect going forward. The market is oversold. It does indeed deserve to bounce. Again, how that bounce kind of goes and how it resembles will give us character and flavor for what comes ahead. Please follow me on X. I'm at David Cox RJ. Thanks again for your time this week. This has been David Cox, Portfolio Manager at Financially in Sync in Waterloo, Canada.